Hey guys, Michael Ketchen here with another episode of the Michael Ketchen Show. Joined as always by Matthew Hitchcock.
How are you doing?
And the one and only Kory Reynolds.
Happy to be here.
It's a big deal. And every time you come, you're probably sick of saying this after all these years, but every time I get you, I get excited. I think everyone gets excited. Everyone loves to hear from you. How's Kory doing? What's Kory think?
I love hearing from you, Mike.
Yeah, well, yeah, probably because he just goes cha-ching.
And he say
Cha-ching.
but at the same time, it saves us, so it's fine.
Yeah, it works out.
I
Yeah.
told you all the time, do not get cheap with the CPA people, which is why we wanted to get this on the books early on. 2025, going to be a crazy year in the world. I mean, it's just going to be, I think we can all agree it's going to be nuts. Crazy time in the market, crazy time in real estate, crazy time in business. You know, I'm going to start off with this question. As CPAs, do you guys follow administration changes pretty closely? Because every 4 years, it kind of...
Yeah, I mean, especially the last, call it since the last time around when Trump was elected,
Yeah.
the number of tax law changes or proposals that have come up with each election has been just
that not
such
normal,
a
how
higher
much he did?
Yeah, it's been such a much higher magnitude than it has in the past. So like the tax law that was passed in 2017, effective for 18, the Tax Cut and Jobs Act, that was the largest change in tax law since 1986 when Reagan kind of overthrew a lot of the existing tax code.
So that's not normal to have an
Yeah, so
administration come in and do that.
Exactly. So that was a huge, huge change. But then within all of those changes, what they did is they had to make it pay for itself because they didn't have enough votes. So they had all of these expirations. So all of these things were, so it pays for itself over the course of a decade. A lot of the tax savings expired within 8 years. So call it the end of 2025. A lot of those tax changes are going away. So that's why actually this election, it was just that much larger of a discussion point because you have all these provisions expiring. The Democrats have one way that they'd like to kind of renew some of those changes because some changes kind of universally groups thought was good. Others thought they could be tweaked. And then other changes like a lot of what Trump wants to do is just renew a lot of what he actually did on the tax savings side.
Because it worked.
Yes. Yeah. Minds may differ. I'll agree with you.
Yeah. Well, but you know what? Again, and jump in here a lot because what I'm going to try to do is, we did not, as you know, in every episode, we did not pre-discuss. Like, there's no loaded up. I told Kory, we might touch on some topics, but I didn't lead you. What I try to tell people, the data I've seen, but I'll ask your unobjective opinion. I've never asked you this question. You hear all the time, oh, Trump's tax cut only favored the wealthy. I disagree based on the data. I actually think it was good for the economy as a whole. As a CPA who sees this holistically, was it largely good for the middle class and the lower middle class, or was it truly all for the top 1% in your opinion? Look at it objectively.
I mean, I'd say when I look at my client base, it's a little jaded in that I don't have a whole lot of people who are just the standard W-2 type jobs.
Yep.
A lot of them are business owners who really were targeted by those tax laws changes and trying to encourage investment and encourage R&D and encourage growth, whether it's, I mean, especially in my world, encourage investment in real estate, whether it's opportunity zones or bonus depreciation. And when I look at those, I really think it certainly did stimulate quite a bit of investment, but it's really hard to break out what was driven by the tax law changes and what was just a really favorable business environment where there was very low interest rates, that a lot of those people just had great business deals, that the tax law changes were a huge amount of icing on that cake.
Yeah.
It was a huge benefit. And I think probably in a number of cases, those tax law changes are what allowed them to continue to reinvest. I think what makes it hard is then 3 years in, COVID was thrown at us. Sure. So especially on a lot of those large projects and a lot of those, because you take a major commercial development project. We'll say the tax law changes are kind of in effect late 2017, or say it was passed in 2017. They might have projects that they then started shortly thereafter that weren't actually completed and they were able to reap the benefits for 3 or 4 years. So then you're getting right into COVID. So it's hard to then say, okay, well, how would they have invested that money differently if then they weren't slammed with COVID? Because it depends. I mean, it depends on the industry too. But when you're looking at the commercial real estate side, when someone's dealing with office space, Well, suddenly no one wants to lend to anybody who's primarily doing office space, or they're
Now
making it
everybody's
very
doing a
difficult.
conversion. Everybody's.
Yeah.
I mean, we've
Yeah,
done a
we've been
couple,
looking at
and
a few.
we're looking at a building right now. I can't talk too much about, but that's one of the things. It's prime. It's a mixed use, and part of it is prime office. And we're having that exact discussion. I talked to your point, no one sees that in the economy. I talked to our lender today, our primary New England lender, loan officer, and he said because of the office component on a deal that size, he's talking about 60% leverage. He's talking about raising 40% of equity now.
Yeah.
On the capital stack. We have never. I get squeamish when I got to go over 25%.
I know.
You talking about 40%?
Yeah, banks are definitely, they're very favorable of just true multifamily projects right
Yes.
now. Yeah.
Yes, and that's going to create some opportunities. And look at that. But I asked that question. I think you answered it well. That was a very political kind of sidestep from
Well,
Kory.
yeah, no, well, I will
it's
say,
hard for them to assess, I guess.
I mean, I certainly saw it. I think on the mid side of the market, I certainly saw some of that where someone, especially where people were interested in going into the real estate investment
Yep.
realm. I'm sure you saw like interest in that, but it's hard to point exactly what caused that in my mind.
Yeah.
Like, all right, well, bigger pockets got bigger and bigger in 2020. And like during that time
the timing of the
Yeah.
powder keg.
Yeah, exactly.
You know?
People were just very interested in going that route. I think COVID actually really fueled that in a lot of ways because people were looking for different entrepreneurial routes to go. And those tax law changes made it easier to do it because it just gave an easiasier cushion to start out those businesses or launch
the remote
into them.
work. But, he just said something, and it's kind of funny, right? So 2017 is when we start, right?
Mm-hmm.
Actually, what year did you start making Newman Noise?
It was in 2015.
Oh, so we really were. You always say
wow.
around the same time. We
I
really
didn't
were
realize it
around
was
the
that
same
close,
time.
yeah.
What's funny though is, and I'm sure you've run into the same thing we have now. Back then, everyone said it's late, it's going to crash. Now, 10 years ago, everybody today, or not even 10 years, everyone today is going, oh man, I wish I had started 7 years ago. That's the point we try to make. It's like when we started our respective careers in 2017, our investing, you at the firm, oh, it's late. I wish the time had been better. It's going to crash. Now, looking back 7 years ago, they go, oh, that time was great. You're so lucky. It's like, guys, the common theme is just start.
Mm-hmm.
Deal with the market conditions you're in and just start. I mean, that's, I think, my biggest takeaway.
Yeah, I also think too, when we got into it, we're trying to ride a wave up.
Yeah.
I think the people that are stalling and keep stalling, they're thinking that they're not going to add, like what we do is we add value. I think a lot of people, they're just not going to add value, and they're just hoping that things appreciate and just stay consistent.
Yeah, that's gambling.
We're a different. That's the difference is we don't gamble.
I
mean,
that's a great
we
way to
do
put it.
gamble, but we don't.
Yeah, I mean, we gamble, but we gamble on ourselves, and we try to force appreciation, which is why, you need a good CPA because, I think Kory and Kath will probably still think we're nuts, but like early on, like the hard money loans, like everybody, I don't want to geek out too much, but when you get depreciation and a tax return, it's very complicated. But one of the benefits of real estate is that velocity, the amortization schedule.
Yeah.
So when you're taking a high interest hard money loan, if you're buying a deal with enough meat on the bone at lower leverage, that means you get to keep more of the upside.
Correct, yeah.
Now it's more expensive to do the project, but all those passive losses, like we were talking about earlier, we had an event earlier today, and we're looking at selling some of our stuff, and one of the guys goes, "Are you worried about all those capital gains?" I said, "Buddy, we got millions of loss. Like I'm not worried about." I said, I think actually exactly what I said was, shout out to Steve Nimzak. I never know how to say it, but he's actually waiting to talk to you. But I said, Steve, if it gets to the point where me, Matt, and Hannah owe taxes this year, we have a really good problem on our hands.
Exactly.
Because that means things went incredibly well.
Yep.
Incredibly well. All right, so we're kind of jumping around. I want to kind of bring it back. So Trump wants to introduce some of the things that were there previously. What else should people be on the lookout? What is kind of on Kory Reynolds' radar as we head into 2025 tax season?
And really, it's a lot of those proposals that were brought up, which some of them are just the extensions, but some of them, I think bonus depreciation.
Oh, we're
is
going to
probably-
talk about that.
Yeah, first and foremost on pretty much every real estate investor's mind. But then I think for a lot of those that are in parallel industries like construction, for example, like the qualified business income deduction is one. That's effectively a phantom 20% deduction of your.
That's the pass through. Can you walk real simple level people through that? What that means?
Yeah. So if you have a very, very simple example, so without this deduction, say you're a small contractor and you're making, we'll go with $200,000 a year. Without this deduction, you're just going to pay tax on that $200,000 of your net profit.
Yeah.
With this deduction, which is still in effect through the end of 2025, and There's all sorts of limitations, but we're going to keep it simple. So you get a 20% phantom deduction. So instead of getting taxed on 200, now you're getting taxed on 160.
Right off the top.
Yep.
Yep. I remember you explaining this when this came out. Yep.
So that can save. I mean, right in that simple example, you're saving tax that close to $15,000 in tax just with that deduction. So just if nothing with that changes, and they do let it expire as of 1/1/2026. If nothing else changes for that contractor, he now owes $15,000 more in tax for that.
Certainly doesn't help the
year.
economy.
No, not at all.
And I believe the other advantage of that when that came through, that made people's general returns a little bit simpler too, right? Because they could just choose to go that route or something like that.
Yeah, well, that was separately. There was the standard deduction change.
Oh, maybe that's what it was.
Yeah, yeah, because whatever the standard deduction was before, they more than about doubled it. It's been a while, so don't
So
quiz
are
me on the
they?
numbers.
Is that on topic to discuss to extend that to keep that?
Yeah, so pretty much everything that Trump did, it's in discussions to extend it.
Okay, and that leads to the big kind of elephant in the room, bonus depreciation. We almost got it back last year. It passed. I don't know the process. It passed the Senate and failed, and I don't know. I should know
One or
this,
the
but-
other, yes.
Yeah, everyone.
I think
yeah.
the Senate's the final one or something.
busy
like that.
running a
it-
business,
It
you know
made
what I
it
mean?
through the House, and it didn't make it through the
Okay.
Senate, or they didn't even vote on it. In the Senate.
So, gun to your head, you're betting all your chips on the table. Is it coming back? Yes or no?
bonus is going to come back, but not at 100%.
You don't
I
think
was on
so?
bet. Yeah,
That's your bet?
and
You just made me very sad, Corey.
I know I probably made.
Why would
a
you
lot
do
of
that?
follow- So
God damn it, Corey.
I know I tend to be a pessimistic person, so
That's
perhaps this is why.
for those people who
Yeah.
watch that, just because he says it, they
Right.
tend to. That's what makes him good at what he does. But it's also your job to do your own research.
Yeah, I mean, I have my logical reasons for it. So, as I said, like the first time around when they passed all of this, they had all these pay-fors. So one of them was, all right, well, we got to phase out bonus depreciation, so we raise more tax revenue later.
Yeah.
There was other pay-fors related to deducting of research and development related expenses, or excess business losses, or being able to carry back losses to prior year income years. So there was all of these things that they made permanent when they did this tax bill last time around.
Okay.
So then the question is, all right, this time, if you bring bonus back again, and you bring back all of these other provisions, well, you don't have more than 60 votes in the Senate. So you're going to have to come up with a way to pay for it. You're going to have the same budget reconciliation process you're going to need to go through. So when you go through that, it's like, all right, is 100% bonus depreciation going to be the hill that everybody wants to die on to get that piece
Yes.
through? Yeah, for some, yes. Or is there going to be other provisions that they care more about, like that qualified business income deduction? So it's really going to be... And the other thing that I keep hearing discussion is like they keep on listing all these priorities that they want to talk about before they talk about a tax bill. So last I heard, and this was at an AICPA real estate conference a few weeks ago, the discussion was, well, maybe like September, October, we'll start talking taxes. Like, and so at that point, it's like, will something actually get done for this year? And then the question is like, would it be retroactive? Because like, if the argument is, especially for something like bonus depreciation, if you're arguing, well, this is to drive economic development, it's hard to say, well, we passed this and we made it effective retroactively. Well, that didn't impact anybody's investment decision.
Because at that point you made your decisions.
Exactly.
And you
So it's
got
going to
with
be
it.
on a go forward basis. So, I mean, maybe it's going to be whenever, like last time around for 100%, it was effective. It was September 27th, 2017. So if assets in service after got 100, assets in service before got 50%. But just where they have to come up with a way to pay for this bill, and they have kind of pulled so many of those levers, I don't think they're not going to be able to just blanket extend everything just because they don't have as many levers to pull. I mean, one of the things that they've just, the Inflation Reduction Act that was passed, that was a couple years ago now, ironically named, of course, that had an immense amount of money.
Oh my God. So, yeah.
Despite what the media told you.
Well, I mean, you can't. This is where we can geek out. We can't go so high level because it's like you can't increase the M2 supply that much.
Yeah.
Like anybody who studies this stuff closely, like we do, like it's obvious what was going to happen. If the average person doesn't care about this because they're busy living their life, the most simple way I can explain it is 40% of all the paper currency that's ever been in circulation, 40% of all the money since the start of this country
Yeah.
was produced in basically an 18-month span. So you basically had 200 something years of history, and then you had 18 months, and 40% of it was basically dumped into the economy. It was pretty obvious what was going to happen. And
Yeah.
here we are.
Yeah, and the Inflation Reduction Act, so much of that was more government spending, which ironically doesn't typically lead to reductions in inflation, but
And then this is what kills me about like CPAs and wealthy. Like that's why I asked you the question. It's like everyone's like, oh, the wealthy, the 1%. It's like, well, I mean, technically we're the 1%. Like I don't. Anybody can do this. The difference is the wealthy people talk to their CPAs, talk to their attorneys, study stuff, make moves accordingly. They don't go Netflix and chill for 40 hours a fucking week while they eat Fritos and play fucking Xbox and then wonder why they're not getting ahead. Show me your actions. I'll show you your outcomes. It's very simple. I mean, we talk quite regularly. Probably don't even talk enough as much as we should now. It's just when I tend to call like a whirlwind. But the point is, back to what we said at the start of this. We started in 2017. You started in 2015. I cannot believe you always said it was close. I didn't realize it was that close. We all just took advantage of these things. Now we happen to be interested in it, so maybe there's that natural inkling to know.
Yeah, there's that additional drive you have.
Yeah,
absolutely.
But I mean, we're in a room this morning doing an event with, I don't know, 10 people, 12 people, whatever was here. And again, I realized like they don't think of this stuff. They react to it. We think of it. Like we're sending out a letter to our investors now. Hey, we file an extension because of this.
Yeah.
I think you said before, most of your clients don't even do that. They're not thinking of that with their investors. Well, if you don't prepare for this, it's going to catch you unawares, and maybe the pass through, the reduction, the standard deduction continues. Maybe bonus depreciation doesn't come back. Maybe it does come back. Maybe something else comes. Opportunity zones, OZs. Those worked out for some people. Other people they didn't. Right.
Yeah.
I remember we talked. We ended up not. I don't think. No, we haven't done an opportunity zone yet.
No, we haven't.
When they came out, though, we talked early on.
Yeah.
What was the thing that you made us aware of with I think it was the Inflation Reduction Act? What was the thing where we were able to file and go back? Because I was a teacher the way we did it. What was that thing that got, do you remember what we did there?
That wasn't the Inflation Reduction Act. That was one of the COVID relief bills, however many there were. All that money that went into the economy was one of those.
Yeah. So he reaches out. You want to explain what it was and talk through that, what that was?
Yeah. It was primarily targeting business owners, but they were able to carry losses back up to 5 years to offset taxable income that it was in prior years. So for you, it ended up going back really to the last period or two that you still had a W-2 job.
Yep.
And we were able to wipe out all the income in those years, and you got a refund from.
Oh, Hannah was very happy with Kory that day. Kory got a special Christmas place in our house, that year. But that's a relationship, and that's what I mean. It's like, okay, so like the conversation we had earlier. Yeah, okay, maybe you're not the average, person's, CPA or whatever it is, but there's a reason for that, right? Like if you're not building a relationship, if you're not doing business, if you're not putting yourself in that position, you're not going to be in a position to take advantage. You get what I'm saying? It's like you kind of pay what you pay for. And I always try to explain to people because I can't think of a better way to say it, but it's like, oh, that's so expensive with your CPA, your attorney. Go, not really. For what we do, I actually think don't overcharge me, but I think it's actually, I'm very happy with the value we get.
You get what you pay for.
Yeah.
Exactly. You want to go to HRR Block?
And we work in a real estate firm, and we recently did this for the employees the first time. I think it was a hit. I think we got another one scheduled. We did a lunch and learn.
Yeah.
And we're trying to get our staff and our team to, think about assets. Like we say it all the time. Like we get hit by a bus tomorrow. We're crossing the street. What happens? Well, you need to be betting on yourself, not just betting on Commonwealth Collective. Yes, we want you to be an employee forever. We want to have the employees and the staff and build that up. But if you're not taking advantage of some of these things, then what are you doing? So it's just interesting how it's all shaking out. What else are you anticipating with Trump coming back?
And so I think on a lot of the development projects, there's definitely been an uptick in the amount of projects that people are chasing after over the next 12 to 24 months.
Yep.
And really some of them, the baseline for those projects were started over the last year or two. but just with that, there's just been an acceleration of interest. You know, like it's like on the contractor side, for example, there's a few guys that were like to call it excavation, electrical, plumbing, and there's actually an interesting anecdote. They said like the month or so leading up to the election, their phones just went silent. Like they're just no one was
Everyone's
calling
waiting
them.
to see what's gonna
Yeah, no
happen.
one was calling them.
There wasn't a lot of confidence.
Yeah, it wasn't a lot of confidence in what was going to happen. And then it was like right after the election, these guys started receiving calls again.
Makes sense.
And booking jobs. And I think part of it is also, I think that there's just, if you got faith in the economy, it's all right, things are going to go better. It's going to be more business friendly. One thing I think, it's very easy to focus on the tax law side of it, but the other side, and you deal with this all the time when you're looking at zoning. And I think part of it's at a local level where zoning regulations and other, I think specifically in the Northeast, places realizing, wait, maybe we do need more multifamily housing. And maybe we should come up with a way for that to make that easier. On the federal level, with Trump coming in, I think it's really going to be an attitude of less regulation.
Yeah.
And that's what he brought in the first time. And that definitely helped a number of businesses. And it's certainly the expectation that he's going to bring that in this time around, too.
I think so. I think it's going to be an interesting 4 years. Like the point you keep making, like he can't be reelected again. So now it's just click, click, boom.
So he's been off the cuff already. Now it's going to be interesting to see how he's off the cuff with no reelection pending.
Yeah, and I think the way that they're laying the framework, I mean, there's only so much you can do in 4 years. But what I go back to what I said, like I don't understand. Well, I do understand. I understand how headlines drive people and everybody. I think people associate like wanting to do the good thing with what they think is good, right? It's like you said, like, oh, how are they going to pay for this tax bill? Well, if you just look at the data, less regulation leads for a healthier economy. I think a healthier economy helps everybody. I mean, it's easy to say, oh, the 1%, the wealthy people. I just disagree with it. And there's no math that backs it up. I mean, the poverty rate's at an all-time low worldwide. People are living better than they ever have worldwide. Now, are we perfect? By no means. A lot of that's where capitalism goes. And capitalism goes where it flows best. I mean, go back, when you listen to this episode, go back and think about what he just said a second ago. Everyone's phone stopped ringing a month before the election because people wanted to see. I can tell you, especially locally here on the New Hampshire level, we were watching the governor race closer than we ever have.
Very close.
Yes.
Because we got to see firsthand the shitstorm that fucking Craig made out here. I'm definitely going to get in trouble for that. I got to think before I go too much off the cuff. But if she had become governor, it would have had a certain impact. Now, we would have figured out that economy. And honestly, maybe would have even been better for us in the sense of how much money they throw at affordable housing and things. But overall, as a state as a whole, I mean, if you can't run a city, how do you run a state?
Yeah.
Right? And to all those people who might say, oh, you're crazy, you're an asshole, whatever, I didn't see you hanging out in Manchester Street.
No.
I saw the homeless population and the feces and the needles. I saw that.
We also had personal conversations with her.
Yeah,
trying to
like-
fix and help solutions.
Yeah, and
change
it's like,
things,
I mean,
but-
I remember we offered to bring in somebody. We were going to pay and have the guy with the company who said, I'll do the needle exchange pickup for free. 3 times we reached out. No one got back to us. I mean, you lead from the front, and I think it's going to be a real good economy. Any tips for, let's try to do it. I'm kind of putting you on the spot here, so this might be hard. Give me a tip for a new real estate investor, and then give me a tip for an advanced real estate investor on their taxes and where the CPA can add some value.
I'd say for the new person, and really is focusing on building your systems and your team. So from a tax perspective, what is that really going to mean? It's like, oh, well, what's your accounting system? It doesn't have to be QuickBooks, whether it's an Excel file, whatever you're doing, come up with something that keeps you organized. You're able to find receipts. You know where it's all coming from. And then primarily when you get to tax time, you actually have some data to discuss and go over and it. And some firms are, I won't say well equipped, but they're okay dealing with a box of receipts. Most firms don't want to deal with it. And it's garbage in, garbage out. So if you give us bad information, there's only so much that we can do.
Yep.
And it's much harder to have conversations throughout the year if you don't know what your numbers are. Your tax is all driven by your numbers. if you're figuring out what those numbers are in March of the following year, then we're just shooting in the dark the rest of the year. It's really hard to give very good advice. For those newer folks, as far as building your team too, I'd say just try and look to see where you're going and see if you'd be able to invest in someone that's going to be a part of your team to help you get there, or at least perhaps a stepping stone that's going to get you in that right direction. We're having this conversation. I was like, if it's someone who they bought a duplex and they're like, I might do 1 or 2 more of these. Yeah, I am not the guy for you. It's just like financially, it's not going to make any sense. But if you're like, all right, I just bought my first and it's a 20 unit and, I'm going ham. I want to do how X number of these a year. I'm growing to this many units.
You can grow into that relationship.
Exactly. Start building that team now. It might feel a little expensive to start. And that's not just your accountants, but that's your attorneys or your property management, whoever else is a part of your team, to start building it from the ground up the right way.
Yeah,
it's a lot harder to start off with the C team and then just keep putting Band-Aids on it and keep trying to make it work. It
actually ends up being a lot more expensive.
Exactly.
Too. That's the thing that I think is so hard to learn early on.
Which we are learning.
Oh yeah. What about the advanced guy? What are you giving him?
I'd say a thought for the kind of the intermediate guy. What you see a lot of times when people are making that step between beginner and more advanced is they start doing syndicated deals, but they might do really small syndications. Like they're doing a project that's less than $1 million. Their raise is, $100,000 or $2,000, and they're bringing in like a whole bunch of $10,000 to $20,000 investors.
Yep.
Avoid that at all costs. From a tax compliance perspective, like you're introducing so much complexity that a lot of the smaller firms aren't going to be able to take care of you. But it's enough complexity that the bigger firms are going to kill your returns, and it's not going to be as much of a value add for you.
Yep.
And you guys are actually a great example. Not that you did this, but the opposite direction, where you built your own thing first.
Yeah.
Before you started going out. So you didn't have to start off syndicating with the $600,000 deal. That if you had to pay thousands for tax prep, just kill the returns on that deal.
100%. And that's, I've said this before. I don't think people understand, at least the way I think about money. So I'll preface it by saying that before I say something controversial. I think the average person, even the average intelligent person, the CPA, attorney, whoever you want to use, doesn't view debt and equity the way we do. And I've said this before, and I'll continue to say this. If you understand velocity of money and the way I believe money works in this economy as a whole, I would rather pay a 15, 20% return all day to keep equity on an upside of an asset that I plan to lever multiple times over a whole period than dilute my equity. I will go to my grave believing that because of what you just said. The way you build wealth, I don't know if you build wealth from cash flow. I think cash flow can sustain you. I don't think you build wealth from transactional flipping. You build wealth from owning assets for a long period of time. And that comes from equity. And once you understand that relationship, and we did it early on, 1, through dumb luck, 2, through just looking at it objectively. I mean, the building you're sitting in right now while we're doing this podcast is a perfect example. And I've told this story before. We bought it for $780 with none of our own money. We had levered a couple other properties. Today it's worth about 2.2, 2.3. We're adding 4 more units in the back. It's gonna be worth about $3 million when we're done. That building has been leveraged so many times for an infinite return because we own all of the equity. We own 100% of it. There's no job that I know of that, something goes from 780 to 3 million in 7 years. I mean, that's $250K in appreciation a year. And we're forcing that as we go. But that's to your point about the debt and the equity thing. Don't make it overly complicated early on. I think it can just kill you and trip you up.
Yeah, it's looking at the entire deal too.
Yeah.
Where it's to your point, people can get caught up in like, well, my debt's this or my interest rate is this. It's like,
talk to a lot of people like that.
Yeah, it's like, what's the whole deal?
Yeah.
Yeah.
The total return is what I call it. And
yeah, exactly.
You start looking at that capital stack. It's like, early on, okay, so you're paying somebody 15%. Okay, well, 15% on $100,000 versus say 8%. Is $7,000 really going to trip you up that much versus if that $100,000 gets you all $1 million worth of the property?
Yeah.
But they see the number on the spreadsheet and they panic. It's There's a reason syndication on bigger deals.
It's unconventional, so it just pops off the page at them, but they're just not thinking, like to your point, they're not thinking down the line.
You remember your parents' CPA? The first time we gave them the 11% promissory note, and their parents' CPA, because then we paid them back the whole thing. They ended up with a 45% annual return, and their CPA was like, "Oh my God, I think they made a mistake." And it's like, no, we knew what we were doing.
We were very deliberate.
That property's now worth $1 million more than what we paid for it.
Yeah.
But their CPA, CPA, smart guy, their family CPA's probably been doing the taxes for 40 years. It's like, oh, is Matthew in trouble? Like, what is Matthew doing? No, Matthew's doing okay. But it's an unconventional approach.
Yeah.
All right, that advanced person, what are you saying to that advanced, sophisticated, like I put you in touch with some heavy hitters. What kind of stands out when you see somebody who's pretty well established, but they can always be better? What kind of tip for those? I know it's a little bit of a harder question, which is why I wanted to ask it. What's some tip you would give somebody in that position?
I'd say the biggest thing is being proactive. I don't know how many times a month I say this, but it is way easier for us to advise you on something if you come to us before anybody has signed anything. It's like if you bring that operating agreement to us on your new deal and say, what do you think? Well, great. Now if you want to fix something, you need to get all 30 partners to sign off on it, or whatever your deal is. So I'd say being proactive in it and being deliberate, whether it's with your attorneys, whether it's with your tax team. So that's having those conversations throughout the year. So one thing I always say with all my clients is whenever something's going on, like just shoot us an email. Just let us know what's up. You're buying a new property and it's the exact same deal you've done 10 times. Cool. All right. Just send us the information. So at least then we'll have an engagement letter set up. Like at minimum, that's got to happen at some point. If it's a new deal, if you're doing anything unusual, you're doing something different, but let's take a look at it.
Yep.
Because a lot of attorneys are very, very good at the legal side and the liability side. Not all of them are so great at the tax side.
To your point, we're about to do a fund. Our next syndication is probably going to be, it is going to be a fund.
Yeah.
Because the opportunity we see coming, we've never done this. You're going to get an email. Captain's going to get an email. We've kind of already planted these seeds, but it's basically going to be, here's a hypothetical. What do you advise?
Yeah,
and
exactly.
then we get comfortable there. We jump over to the securities attorneys. They now have your email to put that together with this advice versus doing it backwards, like you're saying. Now you've got to go, okay, well, you could have done this differently here. You could have done this differently here, yada, yada, yada.
It's a perfect example. So there was a deal that was supposed to close by year end for 2024. And they sent us the draft documents. So perfect. Model client. They did what they were supposed to. And we were looking over it, and it was a relatively unusual structure it wasn't purchase of assets for real estate. It was purchase of units in the partnership to purchase the real estate.
Okay.
And the way that deal would have functioned in the state of New Hampshire is our client would have inherited the other client's New Hampshire tax bill. In this case, that would have been $500,000.
Not good.
Yeah, exactly.
Not good.
If they didn't say anything to us and they just went forward and signed their documents, like their attorneys had written up the documents, everybody was happy with it. And they said, all right, what do you think? Or like, no, that's a terrible deal. Like, he's like, you're walking into $500,000 of deferred New Hampshire tax liability.
Wow.
And then after we ended up having a conversation with our client, we had a conversation with the seller's attorney and the seller. And then all parties were like, yeah, we didn't realize that was going to happen. And yeah, now they're recasting the whole deal and it's going to work out in a way that's much better for our client. But some of those things, like the attorneys might say it's great. I mean, some law firms they have New Hampshire tax or whatever your tax attorneys on staff that'll review it. Not everybody does, but you can end up stepping on those landmines.
Kills everything. I mean, it's $500,000.
Exactly.
That's not chump change. I mean, that could change a whole deal. All right. We could keep going forever, which is why I can watch time. Before we get out of here, where can people get a hold of you?
Yeah, so I mean, they could just shoot me an email, give me a phone call. I mean, we can probably provide that information.
I think
somehow.
we'll link to the email in there.
And I'm somewhat active on LinkedIn. I try and put up content there.
Are you still on Bigger Pockets? You doing anything on there?
I'll post in the tax section once in a while if a interesting question catches my eye.
I see you come up. That's awesome.
Nice. Yeah.
Well, we're definitely going to have you back on, but I can't thank you enough, as always, for coming. Would you have something?
Standard plug.
Oh.
Perfect.
Kory Reynolds is going to be here with Matt for an event on the Standard on, talk about January what?
16th.
Doing tax school.
That sounds about right.
Which I love.
Yep.
Tax school for the members. Why don't you talk a little bit about tax school before we get out of here?
Yeah, see, and I actually do this with a few of my client groups as well, is a lot of times throughout the year, you end up having a conversation and we just tell you, oh, don't do it like that because of X, Y, Z. The idea is then we just have a conversation about, well, here are the technical type of issues that you're normally dealing with. And yeah, like take you to tax school. Here's the real nuance to it. Here's some things that you should be thinking about as you go into those deals. And the goal here is not to put myself out of business or have them take it in-house, but the goal is that now they're aware of some details so that when those deals and issues come up and they're like, oh, wait, yeah, maybe we should give Kory a call.
Yeah, for the $500,000
land. Yeah, but before we get too far down this road, let's have a conversation to see if there's anything else we should be thinking about in this area. Or what I've done with some groups, which it'll be a little bit different this time, but just really a post-op analysis. Like, all right, well, here's a transaction. Here's how it happened. Here's kind of the technical of how it all unfolds. Here's actually a couple other ways you could have done this transaction and how it would have had some nuance, some difference. It's a lot of, a lot of times it was like, all right, so sometimes there's a more tax advantaged way to do a deal, but in the end, it's a business deal. So the tax is secondary. Business deal needs to make sense first. But we might still explore what are those other tax options.
I'd also say, to your point, sometimes the business deal doesn't make sense once you factor in the taxes.
Yeah, they certainly can.
Again, I go back to, we'll have the debate like we always do, but I mean, the total return. I've told you this before about the Airbnb. I know sometimes you say, I don't buy a short-term rental just for that. But like I say all the time, if a lot of, we were talking to Kaylee, my assistant, the other day, and I was like, one thing I never thought of, she's got this small single-family house. Do you short-term rental it for a year to get the bonus appreciation? I don't know. But, if that puts 15, 20 grand back in your pocket, it's nuanced things like that go into it, why I think it's good to be aware of, again, the nuance. I don't have a better way to say it, but it's like, the way I always think about it is like this. Say the example I give, and I was thinking, we got to put this actually, Kaylee, make a note. We got to put this in the calendar of the episode. Because I was like, I got Kory coming. I got to do this. So I was talking, I got to do this. Get a compound interest calculator. And let's just say that you're 30 years old. Mm-hmm. And most people are going to work till they're 65. Let's say that you make, to your point, $200,000 a year in income. No kids, no dependents. What is that person paying in taxes? Probably 40 grand, 50 grand?
Yeah, depending on the state they're in, exactly.
So 50,000, safe?
Yeah, if they're in California or New York or something.
50 grand. Take that $50,000, put it in a compound interest calculator over 35 years. See, I've never said this to you before, but this is how I think about it every time. That's why I'm so big on taxes. Because it's not the tax you're paying in that moment. It's the fact that that dollar no longer works for you for 35 years.
Yeah.
So when you do the math and it compounds, see, people think it's just that dollar. No. Mm-hmm. Over 35 years, that $50,000 probably ends up being in the millions. Actually, I know it will be in the millions, right? So when you think about your expenses and your job and you're thinking about taxes, most people aren't getting that grand deal. That's where I go with it all the time. How do I play the game to position and put that dollar to work? That dollar's going to work. It's going to work. It's going to work. It's going to work.
Yeah.
And that's why I kind of think about it so obsessively. It's like, okay, how do I lower that so that dollar doesn't go into the ether to Uncle Sam to just be pissed away and wasted? You know what I mean? Does that make sense?
Exactly.
That's how I think about it.
So much of tax planning, that's all it is. It's a deferral strategy. I'm paying less tax now. I'm probably going to pay that tax at some point in the future, but for now, that I get to keep that money in my pocket and I get to hopefully invest it the way I want.
Well, then when you adjust for real inflation and everything, I mean, we could geek out and go down this all along, but when I try to walk people through it, that's where I think a lot of our investors go, oh my God, never thought of it that way. It's like, yeah, because you're not conditioned, and one, you're probably not a psychopath, and two, you're not conditioned to think, oh my God, it's like the 401k math, right? Like I say all the time, we're the 401k millionaires, right? The guys who are very successful in the 401ks, guess what? They were very successful at their jobs.
Exactly.
So they're putting a lot of money in. You're not the same. If you're not making $250,000 a year plus, and your 401k is your retirement plan, I'm sorry, you're fucked, and no one told you. You're fucked. The way this government spends money like a drunk sailor, you're fucked. You just don't know it yet. So it's like, what are you going to do? And hope is not a plan. So buy assets, defer the taxes, play the game, bet on yourself, get in the arena.
Talk to Kory.
He's Kory Reynolds. He's Matthew Hitchcock. I'm Michael Ketchen. As always, bet on yourself.